As the closing process became more complex over the decades, consumers often had difficulty understanding settlement costs and identifying whether the fees they were paying were legitimate. This confusion created opportunities for abuse, particularly through referral arrangements, hidden charges, and inflated settlement fees. To protect consumers and increase transparency, Congress enacted the Real Estate Settlement Procedures Act in 1974. Understanding RESPA is essential for real estate professionals because it shapes how settlement costs are disclosed, how escrow accounts are managed, and how settlement service providers interact during a transaction. Earlier chapters explored financing, title insurance, and the closing process. RESPA ties these elements together by regulating how they must be presented to the consumer and preventing practices that would unfairly increase costs. Purpose and scope of RESPA. RESPA is primarily a disclosure and consumer protection statute. Its purpose is to ensure that home buyers understand their settlement costs and are not harmed by referral fees, kickbacks, and unnecessary charges that inflate the cost of buying a home. The Act applies to most federally related mortgage loans, which include loans made by lenders whose deposits are insured by federal agencies, loans insured or guaranteed by the VA or FHA, loans administered by HUD, and loans intended for sale to Fannie Mae, Freddie Mac, or Ginnie Mae. To help real estate professionals, RESPA provides a clear framework for how settlement and loan costs must be disclosed. For example, if a buyer is purchasing a residential property containing 1 to 4 units and obtains a loan from a typical bank or mortgage lender, RESPA nearly always applies. Transactions covered and not covered. RESPA applies to residential real estate transactions involving a first or second mortgage lien. Condominiums, cooperatives, and 1 to 4 family dwellings all fall under RESPA's requirements. RESPA does not apply to all real estate financing. For instance, if a buyer purchases property with cash, seller financing, or a private loan that is not federally related, RESPA does not apply unless the terms of an assumed loan are altered or lender fees exceed $50. Understanding when RESPA applies helps real estate licensees avoid improper disclosures or misunderstandings about settlement procedures. CFPB oversight and rulemaking. Originally enforced by HUD, RESPA rulemaking authority shifted to the Consumer Financial Protection Bureau after the Dodd-Frank Act of 2010. The CFPB modernized the rules, created additional protections for borrowers, and integrated several federal disclosure requirements to prevent confusion. Changes included stronger rules on servicing transfers, new requirements for error resolution, expanded protections related to force-placed insurance, clearer rules on escrow accounts, and enhanced borrower assistance practices, particularly for distressed borrowers. These modern updates made RESPA more accessible and more consistent with contemporary lending practices. TRED, the Integrated Disclosure Framework. One of the most important evolutions of RESPA was the creation of TRED, the TILA-RESPA Integrated Disclosure Rule. Implemented in 2015, TRID replaced the older good faith estimate and HUD-1 settlement statement with 2 new forms, designed to improve clarity. The loan estimate provides borrowers with an early outline of expected costs, and the closing disclosure provides a final summary of all fees and terms. These documents ensure that borrowers can compare loan options, evaluate costs, and avoid unexpected charges. TRID also introduced strict timing rules to guarantee borrowers have adequate time to review their disclosures before closing. Information booklet requirement. Within 3 business days of receiving a loan application, lenders must provide applicants with the CFPB's booklet titled Your Home Loan Toolkit. This booklet explains the mortgage process, settlement costs, and the loan disclosures borrowers will receive. The purpose of this requirement is to educate borrowers early, long before closing, to help them make informed decisions about loan terms and settlement service providers. This is especially important for first-time buyers who may be unfamiliar with how fees, interest rates, escrow accounts, and lender requirements work. Loan estimate. The loan estimate must be provided to borrowers no later than 3 business days after the lender receives a completed loan application. This form explains estimated closing costs, interest rates, projected payments, mortgage insurance requirements, loan features, and other financial details. The loan estimate allows comparison shopping between lenders, and RESP requires consistency between the loan estimate and the final closing disclosure. Cost changes beyond allowed tolerances are prohibited unless certain circumstances justify them. This rule prevents lenders from quoting low rates or fees initially and raising them at closing. Mortgage servicing disclosure. Lenders must also inform borrowers whether they intend to service the loan or transfer servicing rights to another company. Because servicing transfers have historically caused confusion, payment delays, and misapplied funds, RESP requires lenders to explain how borrowers can resolve errors or disputes. This ensures borrowers know where to send payments, who to contact with account issues, and how disputes will be handled. Closing disclosure. The closing disclosure provides borrowers with the exact costs and terms of their loan and settlement. Borrowers must receive the completed closing disclosure no later than 3 business days before closing. This review period allows borrowers to confirm that the loan terms match those outlined on the loan estimate and to question any discrepancies. The closing disclosure includes all charges from the lender and all other third parties involved in the transaction. Treaty rules also prevent lenders from requiring excessive escrow deposits or limiting a borrower's choice of title company. Borrowers may inspect a final updated version of the disclosure 1 business day before closing. Post-settlement disclosures. RESP requires loan servicers to provide borrowers with an annual escrow statement detailing deposits, disbursements, shortages, and overages. These statements allow homeowners to track how much money is being collected and spent on taxes and insurance. When shortages occur, servicers must explain how they will be handled. When overages arise, refunds may be required. Limits on escrow accounts. To protect borrowers from unnecessary or excessive escrow requirements, RESP limits the amount lenders can require borrowers to deposit into escrow accounts. The limits apply to the initial escrow deposit at closing and to ongoing monthly escrow payments. Without these limits, lenders could require unnecessarily large reserves, increasing upfront and monthly costs. Referral fees and kickbacks. One of RESPA's most important consumer protections is its prohibition against referral fees, unearned fees, and kickbacks. Settlement service providers may not exchange anything of value for the referral of business. For instance, a title company cannot pay a real estate agent for sending clients their way if the title company does not perform additional services. Such payments increase settlement costs and distort consumer choice. However, affiliated business arrangements are permitted if the relationship is disclosed in writing. Consumers are free to choose another provider, and no compensation is based on referrals. Understanding title insurance. Under RESPA. Title insurance is closely connected to the closing process because it protects buyers and lenders from claims that may threaten their ownership rights. A title is the collection of legal rights associated with ownership of real estate. A title claim may arise from unpaid taxes, judgments, liens, recording errors, or even missing heirs, because some issues may not appear in public records. Title insurance provides financial protection against unexpected claims. Encumbrances and title risks. Encumbrances are restrictions or claims against a property that may limit an owner's rights. Voluntary encumbrances include mortgages given willingly to a lender, while involuntary encumbrances may include judgment liens or mechanics liens imposed without owner consent. For example, If the previous owner failed to pay a contractor, a lien may be recorded against the property. Title companies identify encumbrances through title searches, but insurance protects against undiscovered claims. Determining insurability. The title company reviews public records, identifies liens or claims, and compiles findings into a title report. Based on what is discovered, the company determines whether title insurance can be issued and what requirements must be met before closing. An attorney's opinion of title may also be used, but it does not provide the financial protection of a title insurance policy. Title policies and protection. A title insurance policy is a contract of indemnity, meaning the insurer compensates the insured for covered losses resulting from past issues affecting title. If a buyer is sued over an unpaid prior tax bill or a forged deed, the insurer may cover the defense and pay the claim. There are two primary types of title policies. The owner's policy protects the buyer's ownership interest up to the purchase price and remains in effect as long as the owner or their heirs have interest in the property. The lender's policy protects the lender's loan amount and decreases as the loan balance is paid down. Lender's title insurance is almost always required in finance transactions. Coverage, exclusions, and conditions. Title insurance policies outline covered risks, but they also contain exclusions and exceptions. Covered risks may include forged documents, unknown heirs, improperly recorded deeds, and unpaid taxes. Exclusions might include zoning issues or claims arising from bankruptcy. Exceptions in Schedule B list specific items not covered, such as easements or unpaid utility bills. Conditions may require the insured to provide notice of claims and proof of loss. Title insurance is a one-time cost paid at closing. Review summary. RESP ensures transparency and consumer protection in the settlement process by regulating disclosures, prohibiting referral fees, and limiting escrow requirements. It applies to most federally related residential mortgage loans and is enforced by the CFPB. TRID integrates RESPA and Truth in Lending disclosures to simplify the process for borrowers by using the loan estimate and closing disclosure. RESPA requires lenders to provide informational booklets, disclose servicing intentions, limit escrow deposits, and issue annual escrow statements. It prohibits referral fees and kickbacks, ensuring consumers choose settlement services freely. Title insurance protects buyers and lenders against defects in the title, and RESPA ensures that its costs and requirements are disclosed clearly. Discussion. Why does RESPA require clear disclosure of settlement costs through the loan estimate and closing disclosure? Answer. These disclosures allow borrowers to compare loan options, prevent unexpected charges, and ensure transparency. They help borrowers understand the true cost of financing and detect changes in loan terms before closing. Why are referral fees prohibited under RESPA? Answer. Referral fees encourage inflated costs and limit consumer choice. They create conflicts of interest where decisions are based on compensation rather than the consumer's best interest. RESPA prohibits such fees to keep settlement costs fair. How does title insurance help protect homebuyers? Answer. Title insurance protects buyers from past claims that could affect their ownership rights, such as unpaid taxes, forged deeds, or undiscovered liens. If a claim arises, the insurer covers legal defense and financial losses. Why is the 3-day review period for the closing disclosure important? Answer. The review period ensures borrowers have time to verify loan terms, identify discrepancies, ask questions, and avoid pressure to sign documents without understanding them. Closing remarks. RESPA is foundational to ethical and transparent real estate practice. It ensures that all consumers, whether first-time buyers or experienced investors, understand their settlement costs, loan terms, and rights throughout the closing process. It strengthens the integrity of the real estate industry by prohibiting abusive practices and empowering consumers with knowledge. As real estate professionals, familiarity with RESPA is essential to guiding clients confidently through financing, title insurance, and closing procedures while maintaining compliance and professionalism.